Hello, future traders, and welcome to your complete crash course on Forex trading for beginners. If you've been curious about the world of currency trading but felt overwhelmed by all the jargon, don't worry, you've come to the right place. By the time this video is over, you'll have a rock-solid foundation, understanding exactly what Forex is, how it all works, and the concrete steps you can take to begin your own trading journey. Ready to dive in? Let's get started. So, first things first, what exactly is Forex? Forex is short for foreign exchange, and it's the largest, most liquid financial market in the world. It's where currencies are bought and sold. Every single day, trillions of dollars are exchanged as people and institutions trade currency pairs like the Euro versus the US dollar, your USD, or the British pound versus the Japanese yen GBP, JPY. When you trade Forex, you're essentially betting on the future direction of one currency against another. The main goal is to profit from the ever-changing exchange rates between these currencies. For instance, if you look at the EUR-USD pair and your analysis tells you that the euro is about to get stronger compared to the US dollar, you would buy the pair. If you're right and the euro's value goes up, you close the trade and pocket the difference. It's all about anticipating these shifts in value. Now that we have the what, let's get into the how. How does Forex trading actually work? As we mentioned, currencies are always traded in pairs. Let's stick with our EUR-USD example. The first currency, the euro, is called the base currency. The second, the US dollar, is the quote currency. The price you see on your screen tells you how many units of the quote currency are needed to buy one single unit of the base currency. Let's make that crystal clear. If you see your USD quoted at 1.2000, it simply means that €1 is currently worth 1.20 US dollars. It's a direct price comparison. So, if your gut and your research suggest the euro is poised for a rally, you would buy the EUR-USD pair. On the flip side, if you think the euro is going to weaken and the dollar will get stronger, you would sell the EUR-USD pair. You can potentially profit whether the market is going up or down. Alright, let's talk vocabulary. Every field has its own language, and Forex is no different. Getting these basic terms down will make everything else so much easier. First up is the pip, which stands for percentage in point. It's the smallest unit of price movement for a currency pair. For most pairs, it's the fourth decimal place, like 0.0001. So if EUR-USD moves from 1.2000 to 1.2001, that's a 1 pip move. Next, we have a lot. A lot is simply a standard unit size for a trade. The standard lot size is 100,000 units of the base currency, but don't panic. Brokers offer mini, micro, and even nano lots, so you can trade with much smaller amounts. Then there's the spread. This is the small difference between the buying price, the ask, and the selling price, the bid. This is essentially the broker's fee for facilitating your trade. Two more crucial terms: leverage and margin. Leverage is a powerful tool that lets you control a large position with a relatively small amount of your own money. For example, with 100-to-1 leverage, you could control a $100,000 position with just $1,000 in your account. This magnifies both potential profits and potential losses. Margin is the actual amount of money required in your account to open that leveraged position. It acts as a good faith deposit, feeling ready to get set up. Let's walk through how to open your very own Forex account. The first step is to choose a reputable, regulated Forex broker. This is super important for the safety of your funds. Look for a broker that offers a free demo account. This is a game changer for beginners. A demo account lets you practice trading with virtual money in a real market environment, so you can learn the ropes without risking a single dollar of your hard-earned cash. Once you've picked your broker, you'll go through a simple sign-up process. You'll provide some basic personal information and verify your identity, which is a standard procedure. After that, you'll need to fund your account. Most brokers offer a variety of convenient methods like bank transfers, credit or debit cards, and popular digital wallets like PayPal or Skrill. Once your account is funded, you're officially ready to trade. You can either jump into the live market or, as I highly recommend, spend some more time honing your skills on that demo account. Okay, your account is set up. Now, what are you looking at on the screen? Let's demystify Forex charts and analysis. Charts are your window into the market's soul. The most common type you'll see is the candlestick chart. Each candle gives you 4 key pieces of information for a specific time period: the opening price, the closing price, the highest price, and the lowest price. Learning to read these candles is a fundamental skill. Now, how do we make sense of all this? We use 2 main types of analysis. The first is technical analysis. This is the art of studying past price movements on a chart to forecast future price action. Traders use tools like trend lines to see the market's direction, moving averages to smooth out price data, and support and resistance levels to identify potential turning points. The second type is fundamental analysis. This involves looking at the bigger economic picture. Things like interest rate decisions from central banks, GDP growth reports, unemployment numbers, and major geopolitical events can all have a huge impact on a currency's value. A well-rounded trader often uses a combination of both technical and fundamental analysis to make informed decisions. This next part is arguably the most important lesson you'll learn: risk management. Trading without a solid risk management plan is like driving a race car without a seatbelt. It's just not smart. Your number one job as a trader is to protect your capital. The most essential tool for this is the stop-loss order. A stop-loss is an order you place with your broker to automatically close your trade if the price moves against you to a certain predetermined level. It limits your potential loss and takes the emotion out of the decision. The flip side of a stop loss is a take profit order. This automatically closes your trade when it reaches a specific profit target you've set. It helps you lock in your gains before the market has a chance to reverse. Another key part of risk management is position sizing. A common rule of thumb is to never risk more than 1 to 2% of your total account balance on any single trade. This discipline ensures that even a string of losses won't wipe out your account, allowing you to stay in the game long term. The moment has come. You've learned the theory, now let's put it into practice and walk through placing your very first trade. Don't worry, it's more straightforward than you think. First, choose your currency pair. As a beginner, it's often best to stick to major, highly liquid pairs like the EUR-USD or USD-JPY. Next, based on your technical and fundamental analysis, decide if you're going to buy or sell. Do you think the base currency will strengthen or weaken? Once you've decided, the next step is crucial. Set your risk management levels. Determine where you will place your stop loss to limit your downside and where you set your take profit to lock in gains. Then you'll enter your position size. Remember what we said about risking only 1 to 2% of your account. Choose your lot size accordingly. Once you've double-checked everything, you execute the trade. And you're in. But the job isn't done. Now you monitor your trade. Watch how the market behaves and manage the position as it unfolds. You can adjust your orders if needed based on new information. Congratulations, Yay! You're officially a Forex trader. And that brings us to the end of our Forex crash course for beginners. We've covered a lot of ground, from the absolute basics of what Forex is, to opening an account, analyzing charts, and most importantly, managing your risk. Remember, while Forex trading can be incredibly exciting and rewarding, it always involves risk. So please, trade responsibly, always use a stop loss, and start small while you're learning. The journey of 1,000 pips begins with a single trade. If you found this guide helpful and it cleared things up for you, I would be so grateful if you could hit that like button. Drop a comment with any questions you have, and of course, subscribe to the channel for more content just like this. I'll do my best to answer every question in the comments. Thank you so much for watching. Happy trading, and I'll see you in the next video.